I'm going to show you how to pick a new real estate market because maybe where you live, the prices are just way too expensive, but you don't have a lot of experience with other markets. So what do you do? Well, I run a community of over 3,000 real estate investors, and they asked me this same question. And so I thought I'm going to give you a grand slam answer. So you live in these expensive coastal cities like San Francisco, San Diego, New York, Miami, Seattle, maybe even Chicago because it's on a coast and it has high population. And the price of these units, each unit is just way too much. You can't find properties that will cash flow, and it's just a real challenge. How do you make money here because you can't afford to buy any of this stuff? And it's really important to find a market where housing is somewhat affordable, the landlord laws are friendly, and the area has a potential for growth. And not just growth as in population, but you also want an area where the market can grow, like geographically, it's not landlocked, meaning the city has room to expand and kind of breathe. And that's the reason coastal cities are so expensive. Well, really one of two reasons. One reason is that people, they want to live near water and have access to nice weather. We're just, as a species, we're just drawn to water. And there's also just so much space. And so each square foot of space just becomes so valuable because there's a lot of people that want to be in a very confined place. So the land share price of each piece of land makes up so much of the property. So what you want to do is you want to find a place where that is less the case. So to solve this, you can do one of two things. So the first thing you can do is you can expand outward. What do I mean by that? What does expand outward mean? Well, by expanding outward, I mean that you take the city that you're familiar with, whichever market that you want to work on, and you go out in concentric circles. So you take the city, Dallas, Texas, or even San Francisco or Miami, and you just go out in concentric circles. And you just keep going out, and you're not tied up or worried about the definition of what is technically Dallas or what is technically San Francisco or what is technically Miami. Like, you're talking about the metro area. Don't be pedantic here about, well, that's not Dallas. The greater Dallas area, right? Do you really care if it's Dallas or Fort Worth or Frisco? You don't. Okay. So you go out in concentric circles and you're looking for, as you go out, it becomes less expensive because the population density has gone down. And out here, this is where people who can't afford to live here live, and they commute in and out, right? Or maybe they work from home now, but basically the cost of living is lower the further away from the city center you go. Generally speaking, that this is true. And so the cost of living here is lower. And what happens here is the price to rent ratio improves. So for example, a place like this, a 3-bedroom, 1-bath, either apartment or a house, might rent for $1,500, whereas the same similarly sized 3-bedroom, 1-bath house or apartment in the city center might rent for $3,000. And so the rent price is going down, right? And then that's the rent right here. It's going down, and the price is also a little bit less. So if you were to sell this as a house, this might sell for what? I mean, who knows? $900K. I'm just kind of making this up. That right here in the city center, that might go for $900K, but a similarly priced place that would now rent for $300, that might cost, $330,000. And so what you're doing is you're taking this price to rent ratio, and you notice that the rent is now proportionately almost half of that, whereas here the rent is 1/3 of that. And so you want to find an area where the price to rent ratio is closer to being, is basically lower. The higher the price to rent ratio, the more expensive it is to live in that area. Now, option number 2 is you just go further afield, because you might find if you're in San Francisco and you start off in the center place and you go out in concentric circles, you may be in Las Vegas before it's affordable, right? Or you may be in Bakersfield before it's affordable. It's not even really part of that same metro anymore. There's just no place in San Francisco probably that is affordable. You'd have to go really, really far out. And at that point, you're really not actually investing in the Bay Area anymore. So this is why I say go further afield. Once you've gone past about 2 hours in places like San Francisco or even like Dallas, if you go an hour and a half out, you're really in the hinterland. You're in a different city, which is still fine. These will be referred to as like tertiary markets, right? So tertiary markets. So you have primary markets like Dallas or, San Francisco, San Fran. These are primary big, like NFL type cities, right? Big cities. And then you have secondary markets that are a little bit smaller, and you probably recognize their names, like Memphis, Tennessee. Or, it's not a primary market, but it's a smaller market. And then tertiary markets are like really small towns that you probably haven't heard of unless they're for some reason already famous or you live in the area. So if you're not from Texas, you don't know where Terrell, Texas is. Like either you went to high school there, you are from there, or you know somebody in your family there, or you don't know what it is at all, right? Like it's too small. The population is like 30K or something, right? 30,000 people. It's a small market. It's a tertiary market. These can be really good markets. Somewhere between these secondary markets and these tertiary markets can be kind of what you're after. Because at this point in the U.S., most primary markets just are too expensive. It just doesn't make sense to invest in these properties anymore because it's just, you can't afford to buy a place where the rent covers your mortgage. There's just no cash flow. And so the further out you go, so you take the United States and you go in these big cities, like Dallas, you take San Francisco, you take Miami, you take New York, you take Nashville, even probably Chicago, you take Seattle. It's just so expensive. These are what they call appreciation markets. These are appreciation. And if you have lots of cash to park, you might plop your money in there. But if you're newer and you don't have a lot of cash, if you're not sitting on $1 million, you haven't inherited money, you haven't sold another property, you have some cash, you're trying to bootstrap yourself into the business. What do? Well, you go to secondary markets. You go to these little tiny towns around here. Like if you're in, like this is it. Let's say this is Atlanta, Georgia. Then there's another city right across the state line here. That's Chattanooga. Right? That's a better market. Here in Nashville, you're going to go to a place called Murfreesboro. In Dallas, you're going to go to a place called Denton. These are the little smaller satellite suburban markets. This is where the working class people live because they can't afford to live in these big expensive cities anymore. That's what you do when I say go further afield. And at this point, once you're investing in these other markets, wherever you are doesn't matter anymore. And thankfully, in this modern day, investing outside of your own market is a viable thing. Now, if you live in an area that makes sense for you to invest, I would prefer for you to invest in your own backyard because you know more about that city than any other city because you just kind of know the vibe of the place. You can hear a county and you know what it is. You can hear a zip code. You can hear about the streets and you kind of know what's going on. You know the culture. You just have this kind of intuitive vibe about the place, and you probably have a network of people to already start with. But if you're in San Francisco, which is where the question came from, this one, it's like I've lived in San Francisco my entire life. I have no connections outside of San Francisco. This has been my world from the day I was born until now. I have where else can I go? It's like, should I try and make it work in San Francisco? No, it's one of the worst markets in to invest in real estate for a beginner. And so no, like you go to Houston or Dallas, and then you don't go probably to Dallas proper. You go to the hinterland around Dallas. You go to Nashville. You go to the hinterland around Dallas. And so you're thinking about the Midwest, the Southeast, Texas, perhaps Arizona, and these are really good markets for you to be able to invest in because one, they just have more land and they have less population density. And in some of those markets like Texas and certain areas of Georgia and the Southeast, the population is growing. And so this is a good thing. So you're in an area where there's a good potential upside, but you can still get in at a price that makes sense for you to hold it for cash flow now. Because these appreciation markets I'm talking about, they're great if you have cash. If you don't have cash, to just plop down, $500,000 for a house or, $2 or $3 million for a small multifamily, what do? Well, you go to these smaller markets like Denton or Chattanooga or Murfreesboro, and that's where you buy for cash flow. And so these kind of flyover states tend to have more of cash flow. They tend to have less appreciation, but they have more cash flow. And so it's a trade-off. So you're not going to buy a property in Chattanooga most likely and have it double in price and value within the next couple of years. Whereas that could happen in some places in California, Miami, and whatnot, right? And so if you can get into those properties and you can afford to hold them, great. The problem is you realistically, as a new investor, you cannot afford to hold these high value properties. And these coastal cities are very sensitive to the ups and downs of the market. So you have big ups and big downs. And if you can't afford to hold the property, then you might really get hurt. And that's why as a beginner, you want to get in for cash flow to begin with. You want the income. to cover your living expenses. So now let's talk about how you would actually go about doing this process. How do you do the analysis of this? So you want to pick your anchor city. So step one, pick your anchor city, whatever that is. I'm going to pick, let's say, Dallas and Nashville, just as an example. These are my anchor cities, and I want to use those as my baseline. And if let's say you're from San Francisco, then you'd probably pick that as your anchor city, just as an example, just to prove the point that it doesn't make sense to invest there. And then what you're going to do is you're going to pull from places like Zillow or Realtor.com. You're going to pull the median home price. Okay. What price do properties tend to trade for? And these are single family, mind you. And here's an important distinction. We invest in commercial real estate a lot, and at least I do it, and I help people do commercial real estate. That doesn't mean I'm anti-single family. I just like multifamily because it scales. You can still use single family data because there's so much of it, and it drives so much of our economy that as the single family market goes, so goes much of the rest of the real estate market. So don't be afraid to pay attention to what's happening in the single family market. Okay, so the next thing you want to do is you want to find the average median monthly rent. Okay. And this you can get from places like Zillow or Rentometer or apartments.com, apartments fully spelled out.com, right? Those are sources. And you can get the median home price that's public data from places like Zillow, Redfin, or Realtor.com. Okay. Now, what you want to find is the cost of living index. What is the cost of living? And this can be found, I like to use Numbeo for this. You find the cost of living index. There's also things like the MIT living wage calculator. And so you go and pull these data. And what I'm going to do is I'm going to provide for you a link to a spreadsheet that walks you through how to actually find this data and plug it all in. And with that spreadsheet, you can do an analysis to figure out if the city you're looking for is a viable, good property or market to invest in. Okay, so that's step one, is to use your anchor city and pull some data so you can get your baseline. Step two is you want to calculate your price to rent ratio. So if a property's median home price was $300,000 and it rented for $1,500 a month, multiply. Okay, so let's go 300K property, the median home price. This is like the Midwest or the Southeast. And then you divide that into what the annual rent is. So you take the $1,500 per month as the annual or the median rent times 12, and that gives you a price to rent ratio of 16.6. And anything less than 15 is favorable. So this market is just above our favorable mark. If it's between 16 and 20, then this is kind of what you call a neutral. And if it's 21 or higher, it's favorable for renting, right? So, we're in that range right here, where this is probably a pretty favorable market to at least consider for our investments. Okay. What's step three? Step three is to do this expansion out into concentric circles. So this is expand outwards, okay? And you can use things like Google Maps or census data to kind of get what is you find your acre city, what is your 30, 90, your 30, 60, 90 radius, right? How many minutes? Like if you drive past an hour and a half, you're probably not in the city anymore. And then for each of these areas, you want to kind of pick what area you can pick. Like here's your Murfreesboro, here's, let's say Franklin for Nashville. And you're going to find that as you pull these numbers, out here is Gallatin, right? And if you're familiar with the area, then you kind of know these areas. And as you start to pull it, you realize that Franklin is like way too expensive. Murfreesboro is better. Gallatin is even better. And you know that because you've gone to pull these data. Like I happen to be familiar with this market, so I have a pretty decent sense of what the major cities in the area are because I only live 6 hours away. We travel here sometimes for family stuff. I kind of know the area. So, okay, now I know areas where I can go pull some data points. And I pull these data points and I go and run the same analysis that I did up here for each of my satellite cities. And you can pick as many as you want. And it really doesn't take that long to do this. Now, step 4 is to go further afield. So let's say you do this analysis and you find out that it doesn't work. You do San Francisco and your suspicions are confirmed that San Francisco and really any kind of area as far out as you go until you hit like Bakersfield doesn't make sense. Okay. So then you go further afield and you do this analysis in areas that you're not familiar with. And so you want to pick a kind of a short list of states and regions that you suspect might be plausible. So Texas, Florida, pretty much all the Southeast, and this could be Oklahoma, it could be Arkansas where I live, it could be Alabama, it could be Georgia, it could be the Carolinas. These are all viable. Or it could be the Midwest. And that could be places like Ohio, it could be Indiana, it could be Illinois, it could be Missouri. So you have cities like St. Louis and Kansas City that you can look at. You can even look at Kansas. Iowa would work. Okay. So lots of choices of areas to go. What you're typically going to be avoiding is places like New York or probably even Colorado. Most places of Colorado, you're going to probably, you're not going to go to Washington. You're not going to go to any of these like high cost of living areas that you kind of know intuitively are not good choices. And so these are your go-tos: Texas, Florida, Southeast, and Midwest. Florida's a weird one. It's its own little animal, and it's such a big state. It's obviously a very coastal place, but there's a lot of cities inside. For example, Jacksonville is a weird dynamic. It's probably if I had to pick a city in Florida, it'd be Jacksonville. For some reason, they seem to be immune to being hit by hurricanes, and it's affordable compared to the rest of Florida. Okay, well, let's take a look at Jacksonville. Maybe it fits that category, and you're not too afraid of the weather concerns of hurricanes. Maybe Jacksonville's if you want to be in Florida, then Jacksonville might be the right choice. Okay, so another level you can go to is you want to apply kind of like legal filters or, factors other than just numbers. And so these are things like landlord laws and, property taxes, which are certainly numbers, but these are like imposed rules that you really can't affect. And then things like job growth. This is a really important idea, is you want to look up in that area, is the population of a given metro, is the metro strong or is it shrinking? And so the problem with some of the Midwest is portions of the Midwest are shrinking. So you want to be careful. Most of the Southeast and Texas is growing. So Texas and Florida are kind of mid on this idea. There's been a lot of people who have moved to Texas and Florida recently, and that their growth has now slowed down as of this recording. That could change in the future, but you just want to be aware of what is the large, and don't think about like what's happened this month or even this year, what's going to happen over the next 5 and 10, 20 years. Because if you're owning property, you're going to be owning property for 20 years potentially. And you want to know about the trend for the next 5, 10, 20 years. And so I built a tracker for you guys to use. I call it the Real Estate Market Analysis Tool. And so what it does is you can put in the city and metro, and then you can pull the median home price, and you can pull in the median rent. And then you can calculate the price to rent ratio, or the calculation does it for you. And then you can put in the cost of living index, and this is all done in the spreadsheet for you. So if you look over here, I've created this spreadsheet. It's a bit of an eye chart. I'll do my best here. And so it gives you instructions on what to pull. I'm trying to make this a little bit bigger for you, a little bit easier. So it gives you a description of what it is. It gives you the rules that I just broke down for you. And it shows you the color code for each, and it gives you the rules for these things you want to pull, like property rate, cost of living index, the price to rent ratio, the landlord friendliness. And it gives you a color-coded place where you can just put in your sample information and it calculates these ratios for you. And I did an example of this using our example cities of Dallas and the Nashville MSA. So I did the anchor city of Dallas and Nashville, and then I pulled in a couple of satellite cities around Dallas. So for Nashville, here's that Murfreesboro, here's that Hendersonville. And if you scroll over here, it gives you the breakdown of which one are landlord friendly. So we give Texas a 5 and out of 5, and we gave Tennessee a 4. They're both pretty good states. And we gave the property rate effectiveness. Property rates are kind of high in Texas. That's one of the downsides of Texas, is that the property taxes are high. But in Tennessee, they're very competitive. Now, cost of living index here. So notice how expensive it is to live in Franklin, Texas. Franklin, Texas is kind of the affluent area of Nashville, and the cost of living is quite high. And then over here, Plano is another one of those kind of affluent areas. So you can see kind of a baseline of, okay, so Plano and Franklin are not good choices just because it's so expensive. And it's reflected in the price to rent ratio. Look how high it is here, 32. Holy smokes. So they're interesting here in Plano, the price to rent ratio really isn't that bad. Like we wanted to be 15, remember, or 15 or 16. Whereas up here it's 32. So 17 is actually pretty competitive, but the cost of living here is still quite high. And so this is kind of an exception where the price to rent ratio there's probably a lot of rental properties in the area that kind of bring this down a little bit. So it's an interesting dynamic. These are patterns you want to look for. But then Tarrant County, Fort Worth, much more affordable. Cost of living index is low. Tax rates actually pretty high, but landlord friendly. And so you do this with enough properties or enough areas, so it helps you find good places to do your marketing or to do your analysis of an area to figure out if this is where you want to do your investing. If you're in a city that you're familiar with, like San Francisco or Miami or New York, but you like, there's no way I can make it work here. Here's how you go and find, with a data approach, better places to go, both from a landlord friendly state, from a tax perspective, and from just a cost affordability issue. So I'll leave the link to the description in the video below, how to go and get that analysis. And there's a whole write-up on how to use it. I appreciate you watching.